Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Dan Matlow, and the CFO, Brian Goffenberg from Vitalhub for an update. Vitalhub trades on the TSX exchange under the symbol VHI and on the OTC under VHI-VF. The company is currently trading at $2.40 with roughly 43 million shares outstanding, or about $104 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Great to have Dan back. Vitalhub, we've interviewed Dan a few times over the past couple of years. Company keeps growing, keeps acquiring, keeps doing what we think are the right things. So I thought it'd be a good time to have you back, Dan. Just update us on what's been going on with the business and what you see going forward. So before we sort of jump into any updates, why don't we refresh everybody's memory and tell us all about what Vitalhub is all about?
Yeah, just for those that haven't had a chance, Vitalhub is a healthcare software IT-based vendor. We're internationally based, headquartered out of Toronto, but we've done a lot of work internationally, and we focused on business to enterprise type of deal. So we tend to sell to larger healthcare-based organizations, be it community health agencies, hospitals, government agency-based stuff. So we're expert in government-funded based healthcare, and we've really focused on those markets. Of course, Canada's a big market. We've done a ton of good work in the UK, but have recently added operations in the Mideast as well as the Australian marketplaces as our four markets, and do have our eye set on the European marketplace as well. So we're truly an international software healthcare IT based organizations. We really have solutions that we've grown through M&A as well as organic growth. So organic growth is equally as important as it is to M&A growth, although we've completed 13 transactions today. We think accretive transactions and synergistic transactions. And the transactions that we've really completed have really focused on two main areas. One we call community health agencies. Those would be organizations that are government owned or government funded, but they're separate organizations. And they're not physician practices and they're not hospitals. They're mid-tier based organizations, tend to be government funded based organizations. And we have a very powerful electronic health record or electronic client record. We use them interchangeably because very often these agencies might not necessarily be healthcare based as well. They could be clients that do. So community agencies, of course, have a big healthcare or mental health based concept to it, but they're not exactly healthcare. So we have a pretty good business on that area, which we have a product called Treat, which is really being elevated to a generation 2 Grace electronic health record. As we've done really well with some bigger RFPs that we've won through 2023 with that solution. And that's been a Canadian only solution, but we have started to move that into our other jurisdictions, and we're excited about some of the opportunities there. And the second area, which is probably recommended, probably be a bigger part of our growth, has been what we call patient flow and operational visibility. That really deals with solutions that help hospitals or organizations understand their patients as they flow through their organizations. What are capacity issues? What's our emergency room backlog? What's our surgery backlogs? How can we look at those analytics in an effective way, both from a hospital perspective, but also from a whole region perspective? So not just looking at the one facility, but looking at the combined facility and how they do that. And then we also have solutions which we call patient engagement or patient journey-based solutions. So those are actually used by the patient. What happens when I register to come in for an outpatient facility? Can I register at a kiosk? Can I register on my phone? Can I see a wayfinding application to help me find my room? When I find my room, where my appointment is am I up on the screen? Can I navigate in? Can I fill out my forms online? Anything that has to do with the patient engagement. And that's a pretty hot area, and we've done pretty well in both those areas. So we're looking to expand organically as well as through M&A in both of those areas to do that, and we continuously focus on those two.
Mm-hmm. Now, you made 2 acquisitions this year. Maybe tell us a little bit about the acquisitions, what it does for your business, and then maybe what the pipeline looks like going forward.
Yeah, I think early on in the year we bought a company called Beautiful Information in the UK. Beautiful Information is smaller based in. It was a competitor to one of our product sets called Transform. One of the product sets, and the other one of the product sets was a brand new offering, but it really gave analytics on how hospitals flow. And we also created something called patient journey boards, which are really just helping understand where the patient is in the journey and being able to understand those analytics of how effectively they're flowing through a hospital system. So that got integrated into our business intelligence group in the UK marketplace. It was a smaller acquisition early on in the year, and we did we did well on that. And then the April-May timeframe, we purchased a product called HiCom, which is one of our bigger acquisitions. HiCom has been around for a long time, but they had a big focus on diabetes-based applications with an application they call Diamond and Twinkle, which is widely used for the UK. And it really had to do with the electronic record and navigation of a patient through the diabetes journey, everything that had to correspond with that in terms of registration, electronic records, reporting, glucose monitoring, but very heavily based in the diabetes-based section, which, as we all know, is a big area of spend and across many different areas. So HiCom brought us into that market and has been productive since we got it.
Yeah, last quarter was a record quarter. I think 9.4 million in revenue. Clearly, some of that comes from the acquisitions, but maybe break down sort of what kind of growth you're getting from acquisitions, and then what you're getting organically.
Yeah, we've over the last 2-3 years, we've really spelled out to our analysts and to our investors. As really the story was, okay, you guys are only going through acquisitions, and we said no, we think our acquisitions are synergistic. So last quarter we announced, I think over the last 2 years, this is a 2-year anniversary of really starting to monitor that, we added 6.4 million of annual recurring revenue organically, and we define that as revenue that's over top of what we acquired. Of course, we're always acquiring some semblance of ARR and annual recurring revenue on every acquisition as part of our methodology, but we think we can add on to it faster than traditionally the organizations had before we bought them. That's proven to be a true case in our thesis in terms of what we did. So we've averaged 800,000 of organic growth per quarter, so on a regular basis over the last 2 years, and we see that trend continuing to do it.
Yeah, fantastic.
Yeah, just overall, the company, overall, I think we're about a 40-something million company with about 32 million of ARR at this point. So we're 80% annual recurring revenue, growing at 15-20% per year on that number on organic.
Fantastic. I mean, the pipeline, a lot of talk about going into recession, things are slowing down. Does that improve the pipeline? Does it make it harder? I mean, tell me what you can.
Yeah, the macro environment, hasn't really changed that much for us. We still see a robust amount of acquisitions. We expect to continue to do acquisitions. We got stuff in the works as we speak. We continue to look at it, and we continue to evaluate it. Maybe a little bit more cautious. I think we've been cautious all the way through, not to to spend what we think it's worth to us, not really what it's worth. So we always model our acquisitions in terms of what it looks like on our side of the pond versus what it looks like before, and how we can you really use that, increase any organic growth, use cost reductions using our offshore development group, try to understand how much of their spend is in technology versus sales and marketing, and really look at an investment thesis on what it means to us. But ideally, we'd like to focus on targets that are already coming with some type of profit already associated with it. We've managed to get our adjusted EBITDA number to the 20% level. We want to sustain that. So we're not looking for places to end, we're looking to increase that on the bottom line. So we would like to get things that somewhat are profitable that we can add to it. If not, we need to get them profitable very quickly.
Now, I mentioned recession. Maybe let's talk a little bit more about the business in general. I mean, I view this as quite recession resistance, if not recession proof. Maybe talk to us a bit about, the business and the kind of the environment we're in right now.
Yeah, we're all government funded as probably as recession proof as you can get as a business in the software tech.
Mm-hmm.
So it's government funded based healthcare. They don't really talk recessions, or we're not really talking slowdowns. Slowdowns and spends would only deal with budgets being controlled, and it's all government controlled based money. We still see an emphasis in healthcare on digitization. There's still a long way to go in digitization of healthcare. We see it in Canada, but we see it abroad as well. So we do anticipate, at least in the short run, that funding should still be available for our offerings. And it's not something recession, I think, totally impacts us, at least at this stage.
Mm-hmm. And just before we went on air, we sort of talked about the general sort of the conditions of the microcap market here in Canada. You guys were fortunate. You raised, you did, I think, a $17.5 million raise or thereabouts earlier in the year. You guys, you're obviously out there looking for acquisitions. Maybe give us a sense of what your balance sheet looks like right now going forward, and sort of the health of that right now.
Yeah, we're sitting, I think, on around 35 million of available cash. We're 10 million in debt, but we just increased our line. We announced that this morning. We just increased our line to a $27 million line and increased our operating line as well. So we got available to us about 50 million of available capital. Half of that would be debt, half would not be debt at this stage in the game. But we're also generating cash from operations as well to add to that on a consistent fashion. So we don't see a capital raise coming in the short term. At this stage in the game, you never know what could happen if something material comes across or whatever, that would have to tap the markets. But just based on the macro environments, that's not where we'd like to go at this stage in the game.
Mm-hmm. And clearly, I mean, the business is self-sustaining. If you were to raise capital, it's really, it's solely for acquisition purposes. So it'd be on a
totally solely for acquisitions. The
Yeah.
company is well positioned. Our expense rate is well below our recurring revenue rate or the stage in the game. So
Mm-hmm.
we're comfortable with what it is.
Mm-hmm. And is there any other sort of new opportunities, whether that be sort of, are you launching new products, new initiatives, anything with sort of the word new in it right now?
Our acquisition targets are based on a number of variables. Of course, we'll buy competitive products to take things out of the market and be able to make money at it. But we're really looking for gaps in our offerings, like where does one thing fit together in our narrative to do that. So we've earmarked a bunch of stuff on the patient journey platforms. We're also looking on the community health agency space to go acquire vendors that allow us to get into another geography. We think the Treat product is a Cadillac in its field, and we're starting to see the second generation of these type of products come into the market. So buying a first generation company that really doesn't have the manpower to uplift its tech to the Cadillac status that we think Treat is, and allows us to break into a geography, would be something that's attractive to us as well. So we're looking for entries into geographies which give us operations in those things. Australia is a key market for us to look at. We already have a bunch of customers there, but we really don't have operations there. So ideally, we'd like to do things from that perspective. So we're looking for gaps in technologies. We're looking for the ability to break into a geography, but they all got to meet our fiscal tests as well to make sure they're viable and they're doing things. So those are the characteristics that we're looking for.
Mm-hmm. Let's talk a little bit about the stock. I mean, you're micro cap and you are a stock, which two things that over the last year have been sort of a negative. Maybe give us a sense of where, you've managed to attract some pretty highly notable investors like the Shen family. And as we mentioned earlier, you're about 75% institutional owned. Why don't you talk a little bit about where you sort of see the industry in terms of, the small public company that's in the space you're in? What can you tell us about, the discussions you've had with any investors, or where do you think we are?
We're constantly in communication with our institutional investors, at least our main ones. They're all very supportive. They're in they've all been long-term investors, and they've communicated that since the beginning. So we anticipate that they're all supportive, and if we ever needed to go back to the capital markets and we're still performing, I think they would be there again to help support us through those markets for sure. So we think from that perspective, we're in pretty good shape. We've never been a big retail based organization. I think we'd like to be. I think it's a good opportunity for a retail investor to hang on the coattails of some of these institutions. I think they're pretty smart, savvy investors. They're looking at this thing for what it is, and have come in all the time, through that. So we're comfortable with our shareholder base and like our shareholder base percent. Of course, we'd like to see our stock in a better position, although we haven't fared as bad as some of the other names, but I don't think we also went up as some of the names. So I think we encourage any retail investors and say, oh, this thing hasn't dropped enough, it's not a good enough deal yet, type of thing. I think if you start looking at some of the metrics in terms of what our recurring revenue is and relative to our share price, what our profitability is relative to our share price, what our revenue is relative to our share price, what our balance sheet looks like relative to others with no debt and cash, and you look at all those equations and look at the market cap, I think you would look at it and say that's pretty attractive. So I think that's where we're situated. Our institutions, they're there to support it. So I think we're in good hands.
And, remind us, what price did you do the financing at?
$3.10 a share.
Right. So anybody buying here obviously would be getting a significant discount from that level of
definitely
pricing.
Definitely.
Yeah.
And the business has grown significantly from then as well.
Yeah. Yeah. Sort of a perfect storm for buyers here, I think, in a situation like this. Now, the other thing I was going to mention is you guys have initiated or at least announced an NCIB. So your intent is to buy back stock. Why? Give us other than the obvious. You think it's cheap? Is that a good use of capital here?
I think it is, unless we get we really get a big avalanche coming down at us of it. But we're not seeing a ton of liquidity, and we're just seeing a little bit of dripping going down all the way through. And I think that's where the NCIB is there to support, just to some degree, to what it is. We have lots of cash. We're supporting our cash. Our currency at some point is going to be important to us, and we know it's a tough hill to climb if it gets down a little bit too low, but it is what it is in terms of what the markets are. So we would like to do our part in trying to maintain our currency. We think they're still getting the albatross. What the last round came in at 310. We still think it's accretive to where it is. We're really, our cash came in at that level, so we still think it's accretive, and we still think we got plenty of cash to do our acquisition. So we debated it a fair bit. There's no real clean cut answer on it, but this was where we came up to.
Good, fair enough. Challenges. What new challenges or old challenges are you facing right now for the business?
Our challenge for our business is really no different. We're just trying to find our acquisitions. Our denominator keeps getting bigger every time we do an acquisition to get organic growth, and that's something that will get a little bit more challenging as we get bigger in terms of, do you maintain 20% growth, or do we start giving 25% on the bottom line and 15% growth, which is probably where we'll start getting to in these type of things. But I think those are the biggest things that we're looking at. We've really, as you get bigger, your infrastructure integration gets a little bit more challenging, but we've really ramped up a pretty good team. We're getting pretty good at it. So we're constantly trying to we're really working on our analytics as a company right now. I think we got some pretty good analytics on how we're performing, our ratio of salespeople to ARR, our ratio of development costs, which products are our best performing from a sales perspective, which ones are our best performing from a money-making based perspective, and trying to focus on those assets that are coming to the bottom line, and really trying to communicate that to our entire management team and our groups, and trying to get them a little bit more analytically focused. So that's a big emphasis that we got on in the company right now. But we're positioning to get around the corner. We see 50 million around the corner for us. We think we're getting close to that run rate, and and then onwards, upwards to the 100 million level. So we'd like to do it sooner than later, but we're in no rush. We're not going to make mistakes along the way. We're not going to go overly fast, and this isn't something that needs to happen overnight. So we're trudging along. We're producing cash. We're making sales, and we just want to progressively improve quarter over quarter, even if it's a little bit. But as long as we just keep moving and that needle in the right direction, I think that's what we're doing.
Now you're a relatively small company with operations in a few different international areas, subject to pretty volatile currencies lately. Are you having any negative or positive effects, material effects from currencies?
The UK pound relative to us has always been a big driver. Just trying to explain to the markets what that means to us. It's sort of not it's number, but it's not real. All of our UK currency is maintained in the UK. So we haven't realized any losses on it. We're still doing it. All of our costs are still in the UK, which is a natural hedge. Yeah, there's a little bit on the profitability of those groups. That's not as high because of where it is, but the costs are in UK, but the revenue is in the pound as well. So there's a little bit of losses on there. Where it really gets reflected is in that ARR number, which is really not a true revenue number anyway. It's just the annual level of recurring revenue. It's not necessarily recognized. It's recognized on a quarterly basis. So there's headwinds in terms of trying to show the growth in there, but there has been growth on a constant currency perspective. And even with the currency exchange, we're still putting out pretty nice growth numbers to it. If the currency level is there, they would be fantastic, even more fantastic. But even with the headwinds, we're doing it. But it is something that's real. And there, we've gained a little bit on the US side, and we've gained in our Sri Lankan operations as well on the currency exchange on that cost base. So they sort of offset each other in many different ways, but net probably a little bit of a loss on the profitability of our UK side. But that's really been the effect of the currency.
Fair enough. Perfect. What looking forward now, especially from an investor seat that we're in, what should we be watching for? Is there any catalysts or milestones that we should pay attention to outside of the obvious potential acquisitions? Is there anything else?
Yeah, I think I'm an investor looking at this business, and you're trying to make educated investment theses on this business, and you believe in our track record, which we've done 13 acquisitions to date, of what we can pay for companies and what we can do for companies. We've been paying between 1.7 and 2.2 times, 2.3 times revenue. We're paying on an EBITDA multiple of what that revenue is. So we got 50 million of available capital. We're a 40-something million company right now, but theoretically, it's a 22 to 27 million dollars worth of revenue we can buy, and we're buying that stuff at it's 60-70% recurring. That's another 12-13 million worth of recurring that we have the ability to buy, yet alone what we're adding organically in the company. If you can extrapolate those numbers, and there's no dilution that comes with that, what that means for a company, that's a 65 million dollar company with well of 40-something million of ARR. And right now we're trading at an enterprise value level of, with the cash, we're trading enterprise level of 90 million, something like that, 80, 90 million of where it's at. So if you believe we can execute, that's really what you're investing in, is our ability to pull that off and our ability to do that. So we're focused on that. We're focused on trying to get to those marks. Will we get there? I don't know. Maybe not quite there, maybe more, maybe a little bit less, but any way you slice it or dice it, we think it's a solid investment for an investor that's looking to invest in a real company.
Dan, have I missed any questions I should have asked? Is there anything else you think that,
Paul,
that we should know?
No, Paul, I think it's a good update for the investors, and we're always available if anyone wants to get more of a one-on-one view or has any questions. They can always reach out to Brian or I. We're always happy to have those conversations, and we're no questions will be unanswered for us.
I think what some of the things you look at now, we're trading at less than 2 times revenue, which is pretty remarkable for a company our size, and an enterprise value, which is only about 75 million because we've got so much cash on hand. GP percentage is 75%. It's north of 75%, 75 to 83%. I think we've had as high as this year. We're generating cash from operations. We're trading at probably about 8-9 times adjusted EBITDA. So we're pretty excited with what we've done and where the company is, and hopefully people will take notice and take us to the next level. And we'd like the currency there to make more acquisitions because we think we can do a lot with them. We've shown we can grow them, and we can operate these entities. So we'd love to be able to get more powder to do that.
No, you guys clearly demonstrated a knack for being able to buy and tuck in businesses very nicely. And with the war chest you have and the balance sheet, as long as the opportunities are there, it looks like there's quite high likelihood you guys will be able to pull it off. So no, this has been great. Thank you so much for the update, and allows us to follow a little bit closer. And always great to talk to you guys, and certainly look forward to the next time we can catch up. And wish you good success going forward.
Thanks, Paul.
Thanks.
All the best to everyone there.
Appreciate
Thanks
it.
again.
Happy Thanksgiving to everyone.
Happy Thanksgiving.
Bye-bye.
Thanks, guys.
Bye-bye.